You for being here to talk about the stability of the banking system. Let's just begin with your association. Who do you represent?
So, Greta, thank you very much for inviting me and for having me. The American Bankers Association, established in roughly 1875, represents essentially all the banks in the United States. There's about 4,700 banks in the United States, the overwhelming majority of which, of course, are small community banks. And then we also have mid-sized banks, regional banks, and a handful of large, globally active banks. And we represent the entire sector, the entire industry.
All right. People are going to be very familiar with this bank, Silicon Valley Bank, as well as Signature Bank. But let's start with SVB. What happened?
So several things happened. First, this is the first bank failure in roughly 3 years or so. We take this very, very seriously when any bank fails. I think what's important to point out is that the overall sector, healthy, well-capitalized, good liquidity footing, resilient. With regard to your question about what happened there were at least 3 factors, and of course we're monitoring and investigating to see exactly what happened. This bank was quite different than the rest and the overwhelming majority of the U.S. banks doing business here today. So first, there was a failure on the management team to manage interest rate risk. There was also a concentration risk. They were just heavily focused on the VC community. They had a large amount of unrealized losses and a huge amount of uninsured deposits, excuse me. So there's a whole set of risk management failures, very unique, particular to this bank. It was idiosyncratic in that sense. Number 2, the Fed is investigating to see if there were supervisory failures as well. If the Feds didn't see some of these kind of flashing yellow and red lights about what was going on there. And third, and this is new, for the first time in the history of our republic, social media was an accelerator, a contributor, not the foundational cause, but social media for the first time was a participant in a bank run in the United States.
Let's talk about the social media, what happened there. Who was doing the tweeting, and then what was the reaction?
So what had happened is roughly a month or so ago, March.
And it wasn't just Twitter either.
No. So one prominent venture capitalist had sent out a note saying, hey, I'm not sure what's going on at this particular institution. We may want to consider pulling money out. That was sent to a lot of other people. Recipients of the note started tweeting about it and posting it on various social media challenges. Hey, there's something going on. Maybe we want to withdraw money. And on that Thursday, the day before the FDIC and the California banking regulators closed the institution, $42 billion was taken out of the institution in less than a day. So the digitization of banking was also a participant. You know, for decades, if you want to take your money out of the bank, you'd walk into a branch. So the fact that social media and the rapid integration of banking and technology was certainly a factor here. And that's why you're seeing, you know, on the part of not just the regulatory bodies, but the legislative bodies, they want to look at this and see if our rules make enough sense and are modernized in a way to keep up with social media.
Are you saying then, when it comes to the digitization of banking, that people wouldn't have access to their money digitally as fast as they did in this situation? Is that something that you would like Congress to look at?
No. What I'm saying is that was a factor. The fact that banking has become so digital was in part why $42 billion was taken out of the bank in less than one business day. So I'm not saying that's necessarily something that requires legislation. I'm not saying that. I'm saying, but that was what made this unique and a bank run along the lines that we've never seen before.
Let's talk about the role of the federal government in oversight here. You talked about red and yellow lights flashing. First of all, who oversees these, all banks? Who was responsible here on the regulating part?
So this bank was overseen by the Federal Reserve and specifically the supervisory executives at the San Francisco Fed. So that was the primary regulator of the Silicon Valley Bank. When you look at the totality of the banking regulators, you have the Federal Reserve, the FDIC, the OCC, and the CFPB. So those 4 regulatory agencies were kind of in harmony around oversight over the banking sector. But this particular bank, SVB, was overseen by the Federal Reserve.
And we heard from regulators recently on Capitol Hill. They testified about what happened there. What did you hear from them?
So what I think was really important is that they're going to do a study. There'll be also a GAO study, but the Federal Reserve itself is looking internally to see, did we miss some things? Did we have the sufficient tools to manage risk at SVB. So they're going to look internally to see, did we miss something? What happened here? Were there supervisory failures? Was this an examination failure versus do we need a whole new set of banking rules? We don't think that is the case. We think this is, again, idiosyncratic. We think the Fed did have the necessary tools to control what was happening at SVB. Again, acknowledging that the foundational purpose here is not the Fed, it's SVB. But that, I think that acknowledgement on the part of Chair Powell, on Vice Chair Barr and others, that they should look and be thoughtful and reflective around what happened here, I thought was incredibly important.
Lawmakers were critical of them, though.
Yep. No, they sure were. And I think there's going to be a lot of questions. You saw the first round of hearings that Chair Brown and Chair McHenry hosted, that we looked at what happened that weekend. You know, the weekend that they resolved those institutions and they took the steps to help stabilize the banking sector. That was kind of the first round of hearings. Next round of hearings will focus on the actual management of the banks themselves. And so those questions will be posed. Then I think we'll have a firmer sense of what happened. So I don't think we need to rush to legislate. It's understandable that people want to do that, but I think we really need to get a sense of the facts first before we encourage a broader, rule writing of the banking sector.
Let's talk about the bank itself. It's the first thing that you talked about, three things that were happening. And you talked about there were losses there. Were the losses related to venture capitalist money?
No, this was their bond portfolio.
Okay, so explain that.
Basically, interest rates had been low for a long time, and then as the Fed announced that they would be going up, the bank didn't hedge that interest rate risk. So that's essentially one of the key failures on the part of the risk management executives at the bank. That was one of the key ones. They also had what is very traditionally called concentration risk. They were just focused kind of on one sector. They didn't have a diversified depositor base. So that's another issue as well. And those together helped create what was, along with social media and other factors, this bank run that occurred about a month or so ago.
Well, that issue alone, that they did not have a diversified depositor portfolio, wouldn't that have been a red flag for regulators?
Those are the questions that are being asked, exactly. And so the regulators are going to do this review of what happened on their part. We're going to see what happened through a whole host of congressional hearings with regard to what the risk management failures on the part of the bank executives were. And then the Fed is also doing, and the GAO is also doing a study on were there exam or supervisory misses as well.
So was Silicon Valley Bank an outlier here, and what happened with Signature Bank?
So Signature Bank was different. These two institutions, again, I think were rather idiosyncratic. Signature Bank had a lot of exposure to the crypto sector, which has cratered in recent months. So that was a very different set of circumstances. There are some characteristics that were similar in that they had a heavy concentration risk to one industry sector. So there were a little bit of similarity there. But I think what's a key message, really important for the American people, the viewers this morning, is that when you look at the entire sector of the 4,700 banks doing business across the United States, the sector is healthy, the sector is resilient, well capitalized, solid liquidity. That's really important to know. And that's not just the head of the American Bankers Association conveying that. That's been conveyed by President Biden, Secretary Yellen, Chairman Powell, Chairman McHenry, Chairman Brown. So that's, I think, a really important message, that what happened at these two institutions is not symbolic or suggestive of a systemic challenge that the sector is facing.
Want to invite our viewers to join us in this conversation. Republicans 202-748-8001, Democrats 202-748-8000, and Independents 202-748-8002. You can also text us, just include your first name, city, and state to 202-748-8003. So what are all the other banks doing that are not in similar trouble to Silicon Valley Bank and Signature Bank? What have they done in recent years, and how are they protecting against interest rates by the Federal Reserve?
So there's a lot of different ways that banks can hedge interest rate risk. There's a lot of products out there. There's a lot of things that banks are doing. I would say just in the last immediate aftermath of the last month, I think a lot of banks, their boards and risk management teams have looked internally to say, how are we doing, folks? So I'm sure those conversations have occurred in boardrooms all across the country. I have a lot of firsthand knowledge of that. And again, the industry on solid footing, so in a very good place. This is not a 2008 all over again. That's another thing I really want to convey to the viewers, that we had a lot of questions like, oh my gosh, is this another like financial crisis? Is this systemic? It's really not. And so I think that's really important for folks to hear. Also, right now, given the very understandable questions on the part of the public policy community, the regulatory folks, the folks in the Biden administration, the folks on Capitol Hill behind you are saying, do we need a new set of laws? So we're actively involved in that conversation right now to say, we really don't think we need to overhaul and rewrite the entire set of banking rules. That would be a misstep.
All right. JB in Hot Springs, Arkansas, Democratic caller. Let's hear from you first. Hi, JB.
Hey, hello, Greta. Mr. Nichols, I've been trying to follow this, what's going on with Silicon. Is that the name of the bank?
Yeah.
Silicon Valley Bank, yes, or SVB for short, JB.
I understand that these people have moved their money in large quantities, billions of dollars from that bank to other banks via the internet or whatever. Now, I bank with a regional bank here. And whenever I call them, like I'm calling you now, I get a menu of services that I can access, moving my money from savings to checking and blah, blah, canceling checks or whatever. Anyway, one of the options I'm not given is to take all my money from that bank and put it into another bank. Like I hear this Silicon Valley stuff is going on. So I'm just curious, how do these people move their money? I can't do it.
Let's talk about that, JB.
So, JB, thank you so much for the call. And regional banks play I noted that you bank in a regional bank. They play a really important role in the U.S. economy, and particularly serving mid-market companies and entities. So I guess I would say this. You do have options at all banks of all sizes, from our nation's smallest community banks to our nation's largest globally active banks, to move money in and out of those accounts. So you do have those options as a general observation. So what happened, though, with regard to Silicon Valley Bank back, again, roughly a month or so ago, is a lot of companies that had their money there decided to pull it out very, very quickly, which created that bank run. You are able to do that really at banks of all sizes. Banks have embraced a digital footing, which we think is good, because ultimately we're giving more choice to customers, and having a healthy and competitive banking sector we think is really important. But I'm glad, JB, that you're happy with. It sounds like you're happy with your regional bank, and they play a really important role in the economy. So stick with them.
Hector, Port St. Lucie, Florida, Independent.
Yes, good morning, Mr. Nichols. Wanted to find out, what do you think of the Dodd-Frank law? Should it be reinstated to protect funds?
So, Hector, thank you for the call. So the Dodd-Frank law is law of the land. So I don't necessarily think we would need to reinstate it, because it's here with us now. And one thing I think is important, though, that you bring up is, as regulators and legislators and the administration looks at the current strife, at the current stress in the sector, the question is, do we want to fight the last battle, the last war, or make sure that we're not just taking those lessons from 10 years ago and bringing them into the public policy debate today? So Dodd-Frank is the law, so it is with us, and I think that as more time has moved on, I think we've seen the parts of Dodd-Frank that really works, and then there's parts also that policymakers have considered over the last 7, 8, 9, 10 years of factoring in. Like, for example, there's a whole set of non-bank entities that are subject to kind of a different set of regulatory standards as banks. And one of the things that we've said, Chair Powell, Secretary Yellen, and so many others have said, Hector, is, gosh, if you're going to do kind of bank-like things, you should be subject to bank-like activity in terms of safety, soundness, systemic protections, and consumer protections. So that's something that we think is important. So as folks look at law, modifying laws, that's, we think, a principle that probably is worth adhering to.
I think Hafter was referring to what people have said is the rollback of Dodd-Frank in 2018, the law that passed. Some have blamed that for what we saw with Silicon Valley Bank.
Yeah, there's nothing in that legislation, though, that prohibited the Fed from imposing stricter oversight on SVB. So we don't really see evidence of that. And I understand that many have asserted that, but there doesn't appear to be evidence for that.
The president is proposing, would like to see more liquidity requirements and enhanced liquidity stress testing. Also, annual supervisory capital stress tests. It's a lot to say this early this morning. Comprehensive resolution plans, also known as living wills. Strong capital requirements for banks at an appropriate time after a considerable transition period. Right. What do you make of those?
So a lot of things there. The president said a lot of things. Some things we agree with, some things we don't necessarily agree with. So first, let's let the dust settle here to see what happened and what didn't happen before we rush to impose different capital or liquidity requirements. It's, I think, really important. I've heard some people on Capitol Hill say, oh, let's just make the whole system safer and jack up capital requirements. I think that might be a misstep. We're going into a period of potential economic uncertainty, Greta, and the idea of ratcheting up capital requirements in a way that could impede economic activity, I think, is something that should be considered very carefully. Obviously, getting the calibration of capital right is really important because you want banks to be able to support the world's largest and most vibrant economy. You don't want to stifle that. You want to make sure, of course, there's enough capital so that we are safe and sound. So I think before we rush to judgment, let's really see what happened here before saying we need this on capital, this on liquidity, et cetera, et cetera.
Some other requests from the Biden administration are expand the FDIC's authority to recoup compensation from executives at banks, strengthen the FDIC's authority to bar executives from holding jobs in the banking industry when their banks fail, and expand the FDIC's authority to bring civil claims against bank executives. Are those good ideas?
Yeah, so first of all, if anyone broke a rule or an existing law, they should be held accountable.
Should they be banned?
Full stop, number one. Number two, before there's some legislative ideas here, in addition to what the President of the United States has said, we want to make sure that we understand the full regulatory authorities that exist today before saying we need to do this, that, and the other, and or more. But make no mistake, if someone broke a law or broke an existing rule, they should be held accountable, period, full stop.
Let's go to Wisconsin. Laverne, and DeForest, Wisconsin, Republican.
Yeah, good morning. I read something yesterday, an email that, not being a financial whiz, I didn't understand, but it sounded as though it might be something that, again, could hurt the little guy. And it's called a bail-in. I'm wondering, bail-in instead of bailout. I'm wondering, what you might know about that.
So, Laverne, I'm not exactly sure, and since I'm not exactly sure, I'd rather not speculate live on television, but look forward to learning more about it.
Sarah in New York, Democratic caller. Hi, Sarah. We're talking with Rob Nichols this morning. He's the president and CEO of the American Bankers Association. Sarah, what's your question or comment?
Good morning. Thank you for the program. So my question is, we have a large universe of 5,000 banks, and every bank is unique. It's unique in its management, business models, and operation, and certainly people. So to manage this universe of 5,000 banks to prevent similar problems from happening, do we really have confidence that regulators can regulate effectively all 5,000 banks and prevent the surprises in future so we don't have to run into similar problems yet again? At the heart of the question is, this banking industry is too complex. Can you really do your job well?
All right, Sarah.
No, Sarah, great question. So let's talk a little bit about the supervisory entities over the U.S. banking system. We have a dual banking system. It's really, I think, powerful and important, and we have good friends at CSBS that we work with every day. Those are the state-facing bank superintendents. So each state has a superintendent of banking all across the country who are looking just within that state. And then you have the 4 federal regulators that I talked about at the Fed, the OCC, the FDIC, and CFPB. At the moment, they're all looking internally to make sure that they have the proper tools to supervise the sector. One thing, Sarah, you said that I think is really important, and when you look at the overall U.S. banking system, it is unique, and it's that uniqueness, that diversity of model that I think really serves the U.S. economy well. We are the envy of the world with regard to our banking system. When I'm overseas, and I talk to my counterparts, they say, gosh, we just have 3 or 4 large institutions. Is that it? How did you get such a vibrant, unique banking sector with, thousands of community banks, some mid-sized banks, some regional banks, and just a handful of large globally active banks? Each serves a unique niche within the U.S. economy that is really important. And that's in part why we have the world's largest and most dynamic and robust economy, because of the banking system. To your point about supervision, listen, they are not only are the state banking superintendents, but those 4 federal regulators are at all times looking to make sure that they have world-class people doing the right job with regard to safety and soundness, systemic protection, as well as consumer protection. So it's ongoing work. It never ends, but it's nonetheless quite important.
Here is a question from a viewer texting in to say, does Mr. Nichols know how many financial institutions are mainly dependent on Treasury bonds that pay 1% interest upon maturity for their liquidity if there were a, quote, run on them?
So I can't tell you exactly how many, caller, but with regard to liquidity, there are a lot of liquidity options, of course, in the marketplace. There's the Federal Home Loan Bank System, number 1. Number 2, the Fed stood up a new liquidity facility over the weekend after SVB collapsed, so that if banks were seeking another liquidity option, apart from, again, what they can borrow overnight, what they can sell, what they have cash on hand, those are the 3 components, of course, of liquidity. So with that new system and the home loan bank system, there's a lot of liquidity options, but I can't cite a number of the 4,700.
Frank's next. He's in Birmingham, Alabama, independent. Hi, Frank.
Good morning. Thank you, Greta, for taking the call. Mr. Nichols, I have a dime-burning question. In November 22, a bank that I haven't talked much about is Silvergate, and Silvergate was in some kind of mix-up with FTX, whereby FTX had caused someone to lose $2 trillion. This happened in November of 22, but all we hear is about Silicon. I want to know what's the distinction between Silicon and Silvergate. When Silvergate is mixed up with the Jones or whoever this was with FTX that lost $2 trillion. And y'all I saw it pop up on CNN, and then it disappeared, and I've heard nothing about Silvergate since that morning.
Okay, Frank.
So
we got it.
Great question, Frank. So, yes, Silvergate, thank you for that. Silvergate also had a significant exposure to the crypto sector, and when it failed, there were not the same degree of contagion possibilities. That's why you didn't hear as much about it in the news as you did as SVB, for example. But again, another idiosyncratic institution with a set of risk management failures as well. And again, in a free market economy, banks can and do fail. We take everyone seriously. It's important, but the banks do on occasion fail, and that's why you have the FDIC. That's why we have deposit insurance, a system that served our nation well for decades. So we do have a system to resolve in an orderly, non-chaotic fashion a bank if it does fail. Again, not something we want to see, but that on occasion can happen.
What role are banks playing in the cryptocurrency market?
So right now, not a huge role. The U.S. regulators, the OCC and the Fed and the FDIC, have been kind of pumping the brakes on banks playing the role of a custodian, for example. So if an American wanted to have some exposure to crypto, could they hold it at their bank the way they could a share of Tesla or Apple stock? Right now, the regulators are saying, we're not really confident about that, so let's hold off on that now. So there's a lot of conversations between the crypto sector and the banking sector, but right now there's not a big set of intertwining characteristics at this point.
Nelson, Pembroke Pines, Florida, Republican. Hi, Nelson.
Hello, good morning. Sir, I'm wondering if the huge amounts of regulations that is involved in the most socialist state in the country, namely California, has anything to do with any of this. I live in South Florida, and we have a lot of refugees from communist countries here, and the huge regulations that have taken place in those countries has added to the collapse of their banking systems. I'm wondering what you think about that. I know that regulations are necessary based on our experiences in 1929, but I'm wondering if maybe the state of California is overdoing it and if that has any bearing. Thank you.
Thanks, Nelson. Appreciate it. Number one, I would say this. Our nation's banking system is the envy of the world. So your comparison with some of the international systems as well, I think, is on point, number one. Number two, we're going to see if the California bank superintendent missed some of these warning signs as well. Again, the Federal Reserve is looking internally to see if they missed anything. And I think the fact that I would imagine that the California bank superintendent may be doing something similar as well.
Related to that, James in Alexandria texts with this question: can you tell me why the risk management team did not warn the manager of SVB that they had a problem?
So James has a great question. I think that's what we're trying to uncover and explore and determine and fact find about, is what happened with the risk managers with regard to the interest rate risk, the compensation, the concentration risk. I read that they didn't have a chief risk officer for the bulk of 2022. That's been reported. So that's why this investigation, both internally at SVB as well as the potential for maybe a supervisory miss, is really important before we rush to do any sort of legislating. Great question, James.
And so will we hear from management of SVB on Capitol Hill? Have you heard?
Yes, we will. So I've talked to both Chair McHenry and Chair Brown, the chair of the Senate Banking Committee, Sherrod Brown from Ohio, the chair of the House Financial Services Committee, Patrick McHenry from North Carolina. Both did a series of hearings already with the regulators. I think the next set will be with the management team from SVB.
Are they going to testify?
I believe they will.
They would not plead the Fifth.
Well, I can't assert if they will or will not plead the Fifth. They will be called to testify. Of that, I am certain.
Are there lawsuits against them?
There may well be.
New Mexico. Dawn, a Republican. Good morning to you.
Well, I'm sorry, I must have called in the wrong line. I'm independent.
Okay, that's all right.
That's all right,
We'll
Dawn.
still take your question or comment.
Okay. I think this gentleman is a little disingenuous. The American Bankers Association advocated for the changes in 2018 that happened under the Trump administration. And under that legislation, what happened is they moved the $50 billion, there was previously a $50 billion base, for Dodd-Frank to be applied to $250 billion. And that $50 billion to $250 billion made a big difference here. Now, if that had been $50 billion, there would have been more Dodd-Frank applied. And the point that I want to make is when these banks collapse, they affect everyone. For instance, the FDIC rates are going to go up now, and we who use local banks here are going to end up getting less as a result of that. The second thing I would like to point out, the largest holder of this bank was Vanguard. Vanguard had the most shares. I have my retirement in Vanguard. So I, living here in New Mexico, who have investments, I lose out when these banks fail. Now, we had an earlier segment on Social Security on how we always bail out the rich. And this is another example how we bail out the affluent and ordinary people lose. Thank you.
So, Don, I'm going to rebut a couple things you said there. One is the legislation from 2018 did nothing to prevent the Fed from imposing stricter oversight on SVB if they wanted to. So that's been a misconception in the marketplace, so I understand how you could view it that way. And secondly, on the word bailout is kind of a loaded term, and I've seen it used a fair amount. I just don't think it's accurate here because there was no taxpayer money put on the table here. The money with regard to ensuring the deposits at SVB north of 250 is going to come out of the Deposit Insurance Fund, not out of taxpayer coffers. So I don't really view it as a bailout, but it is a term that gets used quite a bit.
Is there enough in that fund?
There is enough in that fund. And in fact, Greta, there have been some important questions that have been raised and that will be debated in the weeks and months ahead around what the deposit insurance fund should look like. So yes, there is ample money in the fund to cover the losses here. By the way, we don't know what the losses are yet. So the FDIC is still in the process, Chair Gruenberg, still in the process of resolving SVB. We want that number to be as small as possible, of course, so that they sell the remaining assets and pieces and portions of SVB. Some of it was already picked up by First Citizens, a bank out of Raleigh in North Carolina, but there's other pieces that they're still trying to sell. We want that number to be as small as possible, but it has brought, I think, important questions that we should consider and think about with regard to the future of the deposit insurance architecture in the United States. So, for example, we've had, right now, deposits up to $250,000 are insured by the FDIC. And again, banks pay for that, not taxpayers, banks. So it's not a bailout in that sense that Don was suggesting. Now, the questions are this. Should we look at the deposit insurance system? Should that number be higher? Should it be higher for a business account versus an individual account? Should banks pay into it differently? These are all the questions that we're going to take time. We haven't come up with a position yet, but we want to come up with it, make sure, rather, that our nation's deposit insurance system serves the world's largest economy, serves depositors, and works for the U.S. banking sector.
Do banks make up that obligation that they have under regulation to put money into that fund? Do they make it up with fees on their clients?
No, they are assessed. Well, banks do charge fees for services, and that's an important debate that we can get into. But no, the FDIC sets an annual rate that the banks need to pay into the deposit fund. They review that on occasion. Banks pay into it, and the deposit insurance fund has served our nations well for decades and decades.
Ashland, Pennsylvania. Tom is watching there, an independent. Tom, we'll take your question or comment here.
Hi, thanks for taking my call. I've been hearing lots of rumors about the government going to be pushing for a cashless society, and I guess that would take care of the banking altogether. Is there any truth to this rumor or not?
Hey, Tom, great question. Thank you for asking it. So obviously banking has become more digital. There's a lot of P2P options, Zelle among a host of others, which we do think provide convenience for the customers and clients of banks. So that is true that some people like to use P2P, digital P2P versus cash. I don't think we will go cashless, Tom. I really don't. But there are some broader debates in Washington around the thesis of your question. One, for example, is should there be a central bank digital currency? We think that's kind of a concerning idea and concept. We think we have a really competitive marketplace, and we probably don't need a central bank digital currency that we think could be disintermediating into the free market banking system. So I don't think we ever go fully cashless, but it is true, Tom, that our economy today is more digital with regard to the banking options than ever before, and we think that does provide a lot of convenience and safety and security for people, but there are policy issues associated with it, to your point.
Okay, let's hear from Donna, who's in Wisconsin, independent. Hi, Donna.
Hello. I have a couple questions. One, how could Biden and Janet Yellen wave their magic hand and get rid of the $250,000 guarantee?
Great question, Donna. So what they did, they invoked what's called the systemic risk exemption or designation. For that to occur, the Fed, the FDIC, and the Treasury, by a supermajority, need to decide that needs to occur to help prevent possible contagion. So, Donna, that's what they did. It was the Fed, the FDIC, and the Treasury invoked the systemic risk designation, which allowed them to backstop the deposits at SVB and Signature north of the $250,000 limit that is current law. So what Secretary Yellen has said is that if they see another bank that could fail, that could lead to contagion, that they would possibly consider invoking the systemic risk designation again. But that is the tool of law that they used to go north of the 250 cap.
Dave, who's in South Carolina, independent. Hi, Dave.
Yeah, hi, Greta. Listen, as much as I dislike and distrust politicians, I dislike and distrust bankers much more. The last true representative of a banker, in my opinion, was Milburn Drysdale. Good day.
Thanks, Dave.
Rob Nichols, what about people's views of banks?
Well, listen, when I look at the overall U.S. banking sector, I see what women and men, 2 million of them, 2 million women and men who help create, make dreams come true, take people's ideas and turn them into reality. You know, what banks do in a nutshell is they just aggregate the local savings of that community and then deploy that capital in the form of risk capital so a small businesswoman can take an idea, turn it into reality, hire people, boom, off to the races. It creates hiring opportunity, it creates economic growth, and a bank is foundational to making that happen. The deployment of credit, the intermediation of capital is a really powerful thing. So I understand the gentleman's not a big fan of banks. I am a huge fan of banks and that really important role of, again, aggregating the local savings of that economy and then deploying it in the form of capital so we can create jobs and growth. That's really powerful. It's something I'm passionate about. And it's also why the U.S. banking system is why we have the most diverse, robust, and dynamic economy in the world.
Before we let you go, let's talk about mortgages in the banking industry right now. What's the portfolio looking like for mortgages?
So, well, obviously, with the rising interest rate environment, the housing market has tightened a little bit. And in some parts of the United States, that's probably a good thing because there was housing price inflation was pretty considerable. In other parts of the country, it makes it harder, particularly for first-time home buyers. We work really closely with the realtors, the home builders, and the mortgage bankers to try to get that balance right in terms of both housing supply and demand and making sure the financing options are there as well.
Rob Nichols, President and CEO of the American Bankers Association. You can learn more if you go to aba.com or on Twitter @ABABankers. Thank you very much for the conversation.
Thanks, Greta.
Appreciate it. We're going to take a break. When we come back, we're going to turn to open forum, any public policy issue that is on your mind. There are the lines on your screen, so start dialing in now. We'll be right back.
The name of American, which belongs to you in your national capacity.